recipes for technical trading success in Cook's Kitchen.
Are you ready to talk about the next correction? Listen, it's coming. I can't tell you exactly when, but up here near the highs, it's going to be sooner than next year. And listen, I'm as big a bull as anybody. I'd love to see new highs this summer. But the odds are against it, I think. So let's dive into why. All right, first up, let's look at sentiment. This is the classic investors' intelligence, bulls, bears ratio. This data goes back to 1987. You can see if you look all the way back to 1987, what's kind of fun here is the bulls were very exuberant, reaching almost the 5 level, 5-to-1 bulls to bears right before the stock market crashed in 87. And, you know, the magic and the fun with this data is to buy and sell the extremes. You want to sell the extremes of optimism and you want to buy the extremes of pessimism. Okay, so let's fast forward to the year 2018. Remember this peak? This exceeded the 1987 peak, bulls to bears, and this is where I warned investors in mid-January. We had this peak, or it was pushing up to 5, and I told investors, listen, this market's getting a little frothy. Remember, the Dow went straight up in the first few weeks of January. And, you know, then we got our correction. So where are we now? Well, you know, pessimism dipped. That was a buying opportunity. Pessimism got almost to 2, bulls to bear ratio. But here we are back. We're living around 3. This is as of July 24th. We'll get new data probably today from this survey, today's August 1st. But, you know, looking at last week, you can see a little bit of complacency, right? We're hovering around this 3-to-1, and what has the market done? It's grinded higher up to S&P 2850, broke through that resistance at S&P 2800. Can't make new highs, though, and probably won't this summer. So let's take a look. All right. Well, I want to talk about the big bears on Wall Street. Remember in May, I did this video, should you listen to the big bear on Wall Street? And this was mostly about Morgan Stanley had 2 different strategy teams in April and then again in May who were bearish for their own reasons. And then I also talked about some other fund managers. So let's review what we learned. So here was a tweet from me in April 17th, when Bloomberg shared this Morgan Stanley research note. U.S. stocks may be near cyclical top. Valuations past their peak, per Morgan Stanley. There's less reason to behave like it's morning in America than happy hour in America. Markets are closer to the end of the day than beginning. The Bloomberg summary down here is also worth reading. Investors need to prepare for downside as the end of the economic cycle is near, and U.S. markets are priced for best case scenarios. So says Morgan Stanley. So, you know, and these are investment bank strategists. They have hedge fund clients. They have, you know, they're obviously doing investment banking business with corporations. They don't want to see the bull market end, but, you know, they're busy strategizing. And they see that, hey, we've priced in the best of all possible conditions, even with GDP growth accelerating, which we knew was happening going into Q2. All right. Then in May, a different strategy team comes back from Morgan Stanley and says the end of easy, as it, you know, it's easy to make money in bull markets, right? So they saw 2018 having multiple tailwinds abating, and they think that, you know, all the goodness now gets flipped as far as risk assets because of tightening monetary policy. All right, moving along. Bigger investors I want to talk about. So let me just say, so we just looked at strategy teams from an investment bank, Morgan Stanley. Now let's hear from actual fund managers, guys actually moving the money, you know, from hedge funds and into companies, into stocks. What do they think? Well, I got a little worried when in May, one of my favorite hedge fund managers, Dan Loeb of Third Point, said, this is not a time to be rewarded for long market exposure. And you can stop this video, obviously and read this in full, but to understand Dan's comments back in May, We believe the increase in our short book and our reduced net and gross reflect what we are hearing and seeing. Okay. And then Ray Dalio of Bridgewater, he's been bearish for a while. And that he's the biggest hedge fund manager. So I listen to those guys too because, they're what you would call armchair economists, but they take it pretty seriously and they have deep research teams. So they're looking at lots of company-specific data, market bottom-up, and then lots of top-down macro data, economy top-down, because that's their business. So I listen to them, and they're the guys that are actually going to move money in or out of stocks based on their macro or micro forecasts. All right, but here was my conclusion in May. After all of that, Morgan Stanley, Dan Loeb, Ray Dalio, I said, I don't know what 2019 holds, but I'm willing to wager that 2018 has new highs written all over it. And right now, that bet takes this form: S&P 3000 before S&P 2400. Okay, so how's that worked out so far? Well, you can see in the middle of May, we were chopping around S&P 26, early May, I should say. We bounced off S&P, low 2600s, so we get up in here. Now here we're chopping around S&P, 27, 25, 2750, and, made an attempt higher, had to come back, test that support in the 50-day. This is the S&P 500. And here we are. We finally break through, the old Feb highs here, S&P 2800, and we get all the way to S&P 2848, I think. But just choppy and hard to trade. If you've been doing this, if you've been following me, or you're an active trader on your own, lots of rotation. Sometimes they call it the rolling bear market or the rolling sector slaughter. And, that's what it's been. I've been a big fan of the chips. It's been hard to stay long there while, software soars in Q2. And we're going to look at some other sectors too. We're going to come back to the investors' intelligence data too. I forgot to tell you. We only took one look at it. We're going to take a deeper dive in it to see what the status of correction sentiment is. All right. Now, July 30th, that was Monday of this week. Morgan Stanley again. The Grizzly lives at Morgan Stanley. This is the chief U.S. equity strategist, Michael Wilson. And I clipped a few notes here from a Dow Jones Market Watch reporter, Ryan Lastel. I'm not even going to try and pronounce his last name, but he's written on Morgan Stanley before when they come out with these reports. So what does Michael Wilson and the Stanley team say? We think the selling has just begun. And let me just read a few notes here. Market is showing signs of exhaustion, with major positive catalysts are in the rearview mirror. We got the GDP. We know, that's now in the rearview mirror. So let me read this. With Amazon's strong quarter out of the way and a very strong second quarter GDP number on the tape, investors were finally faced with the proverbial question, what do I have to look forward to now? The selling started slowly, built steadily, and left the biggest winners of the year down the most. The bottom line for us is that we think the selling has just begun, and this correction will be the biggest since the one we experienced in February. Okay. And they think, technology, consumer discretionary, and small caps are the most vulnerable. All right, so where could this correction take us? We're going to run through some charts here real quick. All right, so back to the S&P chart. 10% correction territory takes you all the way down to 2565 from 2850, but, give or take 25 points there. But you have to ask, what's the catalyst? The catalyst could be the midterm elections. All right. Let's look at the leader of the market. Obviously, the NASDAQ, technology, software kind of took over for semiconductors, but still looking tough here, right? It doesn't mean that this can't correct 20%, and it's probably due. You've had, Facebook got took to the woodshed, but today Apple is making new all-time highs above $200. Amazon's obviously strong, Google's strong. Plenty of big cap tech that's strong, holding up the NASDAQ 100, and even biotech has bounced back. All right. Semiconductors. This is our problem child right now. where it's tough to be long. You think you're buying value like a Micron. Boy, you want to own Micron, not because it's trading at 5 times. I mean, that's what memory stocks do. They never trade over 9 times. It's because you think the technology cycle is still strong, or at least I do, and their business is so diversified now because of cloud applications, mobile, artificial intelligence. All right, so semis, it's a tough trade. It looks like we bounce off the 200-day moving average again here in late June. We have a nice July, but not as nice as software and big cap tech. And here we are looking like, oh man, are we going to go back down to the 200? And then if we do, does it crack it? And then it's over for semis. All right, industrials. We have to look at industrials because of the GDP number. And industrials were looking like crap in May, and came back strong, sort of retested in late June, and trying to make a run here for new highs. But is the best news already priced in? That's what you have to wonder. Okay, so back to the investors' intelligence data. Now we're going to look at. Now this comes. I stole these from Ed Yardini because he collects the investors' intelligence data along with lots of other economic data, all his charts. And so the other 2 ways of looking at the investors' intelligence data is to break it out. What percentage of investors are bulls and what percentage are bears, and then who's looking for a correction. Now remember, the investors' intelligence survey is of the newsletter writers like myself, who are advising millions of people on buying stocks, and so their sentiment is good to keep track of. So what do we have here? Top chart, breaking out the bulls and the bears. Bulls in the blue, bears in the red. And you can see, here's the summary of the data over here. Bulls, hovering above 50%. So that's 50% of the newsletter writers are bullish, and less than 20% are bears. So that's, so look at the data over time. Now remember this coming. I mean, look how few people were bearish coming into 2015. You see this? And then we spike. Why? Because of the earnings recession. The market went sideways for 18 months. We're in the earnings recession. As soon as everybody gets bearish, right, the market turns. But here we are back here. So this is complacency, right? Not too many bears. Hey, it's peaked up a little bit here. But remember, this is 1 year here. So really just getting back to 20% bears, seems like more normal territory, but it's still very bullish. And as you can see, the flip side, the bulls up here in the blue. And then now let's look at the bottom chart. Who's looking for a correction? Again, this is 30 years of data, so it's hard to sort out exactly what you're looking at. But okay, this peak right here, this was a peak in the February correction, at the beginning of 2018. But now where we have come down to, we're at one of the lowest points of the year of 2018. We're at one of the lowest points. Around 26% of the newsletter writers are looking for a correction. Only 26%. So this is not a super extreme in sentiment, but we're near the lower bands of bearishness, and we're near the upper bands, generally speaking, of bullishness. So this is usually when corrections come out of the woodwork. I don't know what the catalyst is. I don't see. Listen, the trade war certainly hasn't been that much of a negative catalyst for the market. And the latest $500 billion trade war missile fired at China from the White House didn't dent the market at all. So that's not going to be a catalyst for downside. And yeah, I don't know what is, right? It wasn't Facebook. It won't be Apple. So we're entering August, summer vacations for Wall Street, right? Market is not going to, I really doubt we're going to make new highs above 2850 in August. So the market is going to drift around and chop around. And any bad reports, I think, you're going to see stocks get hit hard, especially in semiconductors, or industrial companies warning that, hey, this trade war is affecting us. And some are doing that. You're starting to hear that now. So what do? We grind in August, and then we start hearing more about the midterm elections and if those become contentious. So that's how you could get a slow grind lower or a correction out of nowhere. For me, I've raised a little bit of cash, and I'm looking for opportunities. I don't see why the market drops 5% in any week in the next 6 weeks, but you never know. And with complacency and net bullishness where it's at, and big strategists warning, hey, this is not the time to think you're going to make easy money, that lends itself to a correction coming out of nowhere. This is the stuff we have to talk about. This is our homework. This is a process you have to go through, I think, at least once a quarter. All right, thanks for joining me in the kitchen.